Now there's this whole thing in terms of they call it amortizing. Amortizing just means if you've got a loan on anything, you know that you have a fixed payment each month and that eventually your balance comes to zero. But amortization, there's a bunch of Excel formulas that go into helping you translate a beginning balance, in other words, how much I borrow, along with an interest rate and how many years I'm going to be paying. So Excel's got an easy function that lets you, it's called a PMT function, but you probably won't have to use that. But the PMT function helps you convert this and then the number of years and then the interest rate, and it tells you, oh, okay, your annual payment will be $25,000 for each year. And then if you want to break that down and see how that plays out, in other words, if you've ever looked at your mortgage book, well, not book anymore, but whatever it is. If you've ever looked at your mortgage payments, you know that a certain portion goes towards interest and the rest stays towards principal. So there's this mechanical kind of process to figure out how much of each of that steady payment, that $25,000, how much of that goes to interest in the first year and how much goes to principal. And just like your home loan, you can see that in the beginning years, most of it's going to interest and less is going to principal. But then at the end, most of it goes to principal and less of it is going to interest. Now, one of the easiest ways to understand why that happens is the reason this interest is big is because your balance due to the bank is still big. So you're paying a lot because you still owe them a lot. But as that balance goes down, you can see here now I only owe them $40,000. And you can see your interest is also lower as it goes down. Now, another one of the assignment questions right here is when you can you recognize liabilities? And again, it's very similar to how you recognize assets. We have to owe that money. We're going to have to pay that money. And somebody else has to agree that that amount is what we should be paying. Now, the rest of the slides talk about these sample transactions and walk through how a given transaction, such as if I buy something, how does it impact the balance sheet? We'll go through that in the assignment. Speaking of the assignment, we're there now. So, assets, liabilities, owner's equity, we already kind of talked about that a lot. Assets is the total street value, liabilities is what we owe, and our equity is what we actually own of that total value, that total asset value. GAAP is those general accounting principles. The requirements for recording an asset and liability we just talked about. To watch how transactions ripple through, these series of problems, 29, 30, and then 31, show you they basically give you a starting position, and right there in green is the starting position from the assignment. So that's how much all these accounts, and this is your cash, your receivables, supplies, and equipment on your asset side there. On liability side, you've got a few numbers, and then your net assets or your equity values as well. So we're going to have, and you can see the long version of each one of these transactions, but over here I have the shortened version as well. And I'll actually work through most of them just so you can kind of see how it works. In this case, the transaction 1, we collect $2,500 in accounts receivable. So when we collect money, that's cash in the door, but our receivables will go down because we are no longer owed that money. We have actually received that money. So that was a simple transaction, plus and minus. Going back to that whole debit and credit thing, there's your debits and credits. Each line, by the way, balances. You notice that this plus this equals 0. But what we've done is we've rearranged our we've rearranged our balances and where they are. So here we started with 135 and 300, and you can see just after this one transaction, the sum down here, the simple sum functions, you can see our accounts receivable is down to 50, and our cash has gone up. Now, not one to let that money burn a hole in our pocket, we did decide to take 100,000 of that and repay, right there, our line of credit. So we come over here and we pay that line of credit. So we've paid that off, but let me make that 0. Sorry about that. There we go. We've paid that off. So that's 0. And then our cash also went down as well. So you can see now our cash situation is updated yet again. Now we still have that money to spend, so here we're going to spend some 25,000 on supplies. So there's 25,000 out of there, and we're going to increase our supplies by 25,000. So you can see we're just going pluses and minuses. And I know if it seems a little bit weird that these don't balance on the liability side, it's like a negative is a negative of a negative, so it's kind of a positive. So if you're wondering why that one didn't quite balance, that's because over here, once we come over here, these are considered negative. So a negative is a positive. Now this fourth transaction was a little bit of a trick, because we have a bill, but it's not due till next year. So we don't even know if we're going to, it's a simple membership thing. We don't know if we're going to pay that or not. So there's no need to recognize that right away. You could you might think we should recognize it as a liability, but it's not an actual liability because we didn't receive anything for it. Like if we had bought something on credit, then we would definitely want to record something there in the accounts payable. But by the same token, again, because things have to balance, we have to recognize that our cash went down, our cash went down because we had to pay for that, or that our equipment went up. We'd have to recognize something over here, but because we have not received anything of value yet, that's just a blank line. In the next one, we buy a bunch of exam tables. So it looks like we're going to have our equipment increase by 50,000. There we go. And we are told that we're going to spend 10,000 in cash. So our cash goes down 10,000. And we're going to put the rest in a bill or payable. So, basically invoice us for that. So there's that transaction. Again, we all balance out okay. And finally, we pay. Remember I was talking about that of IBNRs earlier. In this last line, we're going to pay 65,000 that was due to employees at the end of the year. So there's that cash out because we write checks to our employees. But there is this wage payable thing which now goes down by 65,000 also. Now, after all those transactions, you can actually see this bottom formula. The bottom formula is just a sum from the top, and then it adds all the transactions that goes down. We've got this thing right here. Now, if you just flip this sideways, you can even see these formulas right here. Well, they're not formulas, they're values. But you can even see there's a 185, there's a 50. So all we did is we took all these numbers and turned them sideways to create something that looks like a balance sheet, which is right here, which answers that last problem in the chapter.